Equities are in the air. When will it rain again? And how to prepare for the same. This is the topic of our first session, ladies and gentlemen, which is going to be an engaging one-on-one conversation between Mr. Prateek Pant from White Oak Capital Management and Mr. Kamal Manocha from PMS AIF World. Let me take a moment to introduce the gentlemen. Mr. Prateek Pant is the Chief Business Officer at White Oak Capital Management, and he's responsible for driving the overall business objectives through multiple distribution channels, innovative marketing strategies, including digital and effective product architecture. He has over 25 years of experience in banking and financial services in India and the Middle East. Prior to White Oak, Mr. Prateek was the head of products and solutions at Sanctum Wealth Management, as was also a part of the founding management team. Now, ladies and gentlemen, Mr. Prateek Pant holds a bachelor's degree in engineering and an MMS degree from JBIMS Mumbai with a specialization in finance. I extend a very hearty welcome to him as he joins us today in this very relevant chat. We have with us Mr. Kamal Manocha, founder and chief executive officer at PMS AIF World. He is responsible for driving the overall business across both wealth management as well as content management. PMS AIF World has conceptualized various innovations under his capable thought leadership, the most recent one being the quality, risk, and consistency framework created to deep dive the space of portfolio management services. Mr. Manocha brings with him 18 years of experience, holds a master's degree in management, a bachelor's degree in economics from Hansraj College, Delhi University. Once again, let me inform all of you that the two will discuss summer of 22, while equity is in the air, when will it rain again, and how to prepare for the same. With that, a very warm welcome to our speaker, Mr. Prateek Pant and Mr. Kamal Manocha. And with that, it is now over to you, Mr. Manocha. Take it away.
Thank you so much, Aishwarya. I think it has been a wonderful beginning. And welcome, Prateek. It's a pleasure to converse with you for this event, as a beginning of this event. And the topic, as Aishwarya rightly mentioned, is summer of 22. While equity is in the air, when will it rain again? And this is the thought which is there in everybody's mind. So we want to kind of understand from you, being a chief business officer of one of the youngest and fastest growing AMCs today, that what are the views, what are the perspectives that you have, to tell us today with regards to this particular aspect. So the very first question, which comes to my mind is that when it comes to decision making, all of us are emotional, and we, quote this particular aspect when it comes to making investment decisions with things like various biases. And one of the very, well-known biases is called a recency bias. I'll give you an example. Recency bias is so deep that it does not just, make investors kind of make decisions on what to invest or where to invest. It also makes them take decisions on what kind of a fee option to take. For example, during March of 2020, the last time when we saw markets going down, the most hot selling product at that point of time was a consistent compounders portfolio. When markets were so low, the P's were so low, the price of equity market had fallen almost 40% at that level. Because of the, recency bias, they went on to invest into products like, consistent compounders and took a fee structure, which was a variable fee structure, because, they were kind of the view that returns have not come in the past 2 years, and maybe, they may not come, and ultimately ended up paying 5-6% of the fees. So, when the investor thought process is emotional, the entire asset management and wealth management industry should ideally, do something to ensure that investors actually make informed decisions. And maybe, the endeavors that we are trying to do with all these webinars and all these events is one of the, I would say, the motivations is to actually help them to make, such decisions. And you being chief business officer of one of the youngest, I again say, and fastest growing AMC, what are your views, in this regard? So basically, are all these fund managers in this context trying to sell a story to a fund manager and appeal them emotionally, or there is something, rational around it, which you as a fund house want to convey?
Sure. Thanks, Kamal, for having me here. This is a great forum we've been associated with, and we love the participation which we get in this particular forum. On a lighter note, the topic, it's been raining last week or 2 weeks quite heavily in Bombay anyway. And I think even if you see from a market's perspective, the first week, you're seeing the rains in the market right now. But that's more on a lighter note right now, Kamal, because I really like the topic which you had put for our discussion. On the recency bias, it's very interesting. We just launched our byline today, right? The art and science of investing. And in fact, when we were having this whole deliberation about the investment philosophy, the process at White Oak, our initial thought process was around bringing science to the art of investing, right? If you see, Kamal, normally when you look at a lot of literature, uh, they don't refer it to a science of investing, but more often it refers to art of investing. And the reason is around a lot of behavioral biases which are there, right? It's because investing is not a perfect science. I mean, the science is the process, the science is the stock selection, the science is definitely in analyzing all those ratios and coming up and creating those portfolios. But the art of it is actually being able to execute some of these things. Behavioral biases, whether it comes to fees, whether it comes to people thinking they can time the market, whether it's about your own experiences, which sometimes catch. I mean, it creates those level of biases in your mind. And in our assessment, Kamal, that's where having a good manager, having good advisors who can guide you through these processes become very important. Because otherwise, this whole paradigm about trying to buy low, sell high, and some of these messages which get miscommunicated to a lot of investors, feed into some of these type of biases. So I don't think there is there is a fixed solution around it. Some of the time, at times it's just the experience and your own personal journey with investments which help you navigate this. But we've all talked about power of compounding. We've talked about staying in markets. We've talked about the fact that even like, for example, at White Oak, we do offer fixed fee and variable fee models, right? But we do encourage investors to actually look at what has been the experience on variable fees over a much longer decade of Prashant's own track record, rather than just White Oak's last 5 years pedigree, to arrive at what pricing suits for them. So it's a journey, Kamal, and it's a journey which asset managers, advisors, and investors will take over a period of time. You will always have new investors who will come and again learn this, but there is no band-aid solution to something like this.
Sure, and well said. So the next relevant question that while you were talking came to my mind is that today, when we kind of look at White Oak, the positioning of White Oak is an alpha focused and equity focused fund house. And when investors invest in a product like yours, they kind of decide to pay fees which is around 3 to 4 times more than a passive fund. Obviously, when they do take this decision, in return what they expect is a good quality portfolio with right allocations, and at the same time some meaningful alpha for whatever their higher fee they are paying over and above a passive fund. At present, your fund house is around 3.5 to 4 years old. But what I have seen in the past 3.5, 4 years across most of your products, alpha in the last 2 years at least, is not visible. Alpha was there till 1.5, 2 years ago, but after this recent correction of 8 months, the alpha has actually evaporated. Obviously, on the first expectation of investor, which is the quality of the portfolio, the view is absolutely very positive. But the view with regards to alpha today, I can tell you the realistic question coming from investors is there, that why has alpha not been there, and what is the science, and what is the guidance that you kind of gave? And if you are in the place of investors, would you actually give money to an active fund manager, or you would yourself kind of be proponent of a passive investing?
No, great. Thanks, Kamal, for asking this question. And I have a couple of slides which actually depicts what is happening in the market at this point of time. We've of course looked at different phases of markets, and this particular phase of the market is over the last 6 months has been particularly challenging, right? And when, so just to a point, right? It's not that we haven't been able to deliver alpha over the last 2 odd years. The erosion of whatever alpha which has been delivered is been severe over the last 6 months. So, and that's why for an investor who tries looking at point-to-point return, it may appear that nothing has happened over the last 2 years, but it's actually the last 6 months performance which would have dragged longer, 18 to 24 months type of a returns. So if just on this particular slide, if you look at what's happened in the last 6 months, while the markets have given negative returns, right, and the negative returns could be to the tune of 10 to 15%, which the BSE 500 would have given. These sectors which have actually done well include sectors like utility, energy, oil and gas. Some of the worst performing sectors are sectors like IT, consumer, banking, financial services. Now, you would appreciate the fact, Kamal, that if you look at the last 10 days, what has happened, this graph could have been almost inversed at this point of time. And you've seen the type of sharp drawdown which has happened in energy. You've seen sharp drawdown in some of the commodity metals space and things like that. So when you have a very polarized market, when you find areas of commodities and I mean when we construct a balanced portfolio, typically, Kamal, we do take some factor risks in our portfolio, and the factor risks include that we tend to have very low or almost negligible ownership in areas like utilities, oil and gas, public sector, and it's not it's our own framework of buying great businesses at attractive values. We don't really find those type of values in these type of companies. We tend to be over-owned in sectors like IT, in sectors like consumer, BFSI, because we find good quality businesses with strong excess return on incremental capital. Now, over a short period like 6 months, where due to other macro events, you may have seen some of these factor risks play out, and quite in a very exaggerated way. But we do find that, on a longer term basis, there is mean reversion which happens. So if you had to really, rather than looking at point-to-point return, when we look at rolling returns, right, or we look at slightly longer term, averages, you would find, these things could equally reverse as fast as they've played out right now. Another interesting data point on my next slide, if you see, has been which have been the best performing and the worst performing companies of the first 6 months. And it's no surprise that you'll find one of the groups where these companies, which has dominated quite significantly with returns of more than 40-50% in those companies. While, the right side is quite astounding, right? When you find some good quality tech companies, right? 7, 8 names out of the 10 names which have not done well are actually companies in the technology space. And there's nothing wrong with these companies. It's just that in some of the cases, they were over-owned by FIs. They could have been, there's a tech meltdown which was happening in the US, which was more in the .com verse or the e-commerce world, which was there. Let's put it that way, right? And somewhere you've had a similar sell-off which has happened in that companies where the revenues have not really been impacted of these companies. So I guess and that's where when I look at a chart like this, or I look at a chart like what I've seen, what I showed in the first particular slide, it gives me confidence that you will have an equal strong pullback in good quality companies. And if clients have come and allocated money for a 3 to 5 year period in equities, which is what the mandate always is, there would be significant alpha potential, which they've seen in the past, and they will continue to see in a white oak strategy.
Sure. Right, Prateek. Going to the next question, which again is a very real question that today we have on our minds, is that we are representing India as an economy, and on one side for last 8 months consistently over I would say every trading day, FIIs have been constantly selling, and at the same time DIIs have been constantly buying. Now, because this is happening in a very consistent, in a very I would say long-term way, in the sense that over last 9 months it has been happening like that, and the quantum of total selling done by FIIs is actually very, very large. So what is it, what is happening? So are we actually overselling India story to our clients, or is it that FIIs are underestimating the potential of India's economy, over say next 5-10 years in this decade?
Yeah, Kamal, this has been a billions of dollar question which you asked, and this is of course being discussed in every possible forum where I participate. So I've got again a few graphs to illustrate what has been happening, right? So you're right that if you had to see the FII outflows on a year-on-year basis, on a month-on-month basis, we've probably seen some of the largest outflows, in more than a decade, right? Having said that, of course, that has got neutralized by, to a large extent, I wouldn't say completely, but large extent by buying both domestic mutual funds as well as the type of SIP flows, which are, now steady, one could say 10-12,000 crores a month, which actually comes in through that bucket. If I had to show you in the next slide, right, in terms of what is the constitution of this FI. So, we do tend to at times club everything under FII, right? So today there's about $625 billion of FIR or FPI, AUM, which is there. Now at White Oak, you would be aware, Kamal, that we're probably one of the largest foreign portfolio investors in India. Today we manage almost $5 billion of overseas capital, which has been invested by FPIs and overseas institutions into India through different funds which are there. Now, the proportion of this India dedicated active funds is actually quite less in the total constitution, right? It's just 6% of $625 billion. There's a lot of global funds which has India as part of that exposure, which is the non-dedicated active fund, which is about 70%, right? And then there are also a lot of passive funds, which are actually the non-dedicated passive funds. So I think the issue, what happens is, so there are two things which are happening globally, right? One is that you're seeing a lot of, you're seeing interest rates move up in the US. Suddenly, you see US treasuries, people talk 3.5%, 4%, reaching those type of levels. So when dollar returns tend to be very attractive for, the offshore investors, then their own propensity to take that level of risk in emerging markets actually drops down. And this is not the first time you've seen something like that. The second is, emerging markets have not necessarily been a darling, right? Where you had events in Russia, we've seen the geopolitical issues. We also seen what has happened in China, where there's been a lot of loss of confidence in many of these overseas investors. India gets clubbed with this whole emerging market bucket, right? And when there is this non-dedicated active funds or the ETFs, which start selling out, you will, to that extent of 10-15% exposure in that particular fund, also start selling out. In fact, if you had to, if you actually see the nature of flows, which are there in the next slide, which I have out here, right, in terms of where have you actually seen the outflows which have come through, the largest part, as you see, has been this non-dedicated active flows, which are there, and if you see, the sovereign wealth funds have actually been net buyers into India, the small green, bar which is out there. So automatically, this just makes you realize that it's not that there is a basket selling of India happening, but there is a larger selling of the entire, EM bucket or global equities, which has actually happened at this point of time, and money which is chasing yields, which are a lot more safer when you look at US treasuries, which are there. And in a way, that's really, these are the type of things which actually create then some sort of opportunities in the longer run. But I think one should just take out from this that I don't think there is a India missell which has happened in the market. India still continues to be fairly compelling, at least when we talk to our clients offshore. I can assure you, Kamal, we've not had any large redemption over the last 6 months, right? And in fact, we continue to actively engage with a lot of our international global clients who park longer term capital out here. And you will see some of this reversal again happening the moment the worries around inflation, rate hikes, and all these things stabilize, US treasuries stabilize. You would start seeing risk capital again flow back into emerging markets, and in a way, larger allocation now come into India compared to some of the other peers we have.
Sure. I think these two slides were very meaningful. Moving on to the next question, when we started, in 2018, our platform PMSAF World, the very first forum that we did in 2019, we kind of named that event as Crystal Gazing Next Decade of Wealth Creation for Investors, because we also, being long-term believers of wealth creation through equities, kind of had this idea that next decade is a golden decade. And today, in front of us, this decade has started in 2020 with COVID. And now, in the second year, we have an era of war, an era of inflation, an era of rise and fall in commodity prices. And obviously, some of these macro factors, I know Mr. Prashant Khemka, who is the founder of Vito, quotes them as entertainment. I agree to that, right? But the thing is, from the perspective of equity investors who have actually invested in last 1.5, 2 years, and there are many new investors who have come to equities in asset class, and many older investors have increased their allocation seriously to equities in asset class. How to reinforce and what are the factors or maybe economic data points that you can share to kind of convey and ensure that trust towards this decade being a golden decade remains?
So, it's always very difficult to crystal gaze, Kamal, right? And try forming views of what's going to happen over the next decade. One of the we've been very big believers in the power of technology and the innovation which that throws and the productivity gains which are actually coming through, because of how technology is changing a lot of paradigms. While you may have these temporary challenges around interest rates, inflation, disruption in supply chain because of geopolitical issues, the reality is that the world is actually becoming a lot better place in terms of the type of innovations which we keep seeing around us. So it's as you rightly said, Kamal, we don't take macro calls, right, in deciding how do we construct our portfolios. For us, what is important is the same philosophy of how do we identify these great businesses which can ride volatility and then create portfolios which have cyclicals and counter cyclicals, right, to be able to balance out volatility which comes into any type of market scenarios which happens. So I think as long as as long as investors believe that the India story is intact, right, very few options globally exist of 6% plus type of growth rates. Demographics continue to be very strong. You may have years or a few quarters where there could be challenges due to macro headwinds. But overall, I mean, this is a time when we're seeing, if I have to look at right now, you can always look at glass half empty or half full, right? The way we are seeing actually is massive productivity gains because of technology. The fact that after more than a decade, you're seeing some revival of corporate earnings and solid earnings. There may be margin compressions at the periphery, but again, innovation is ensuring that there are productivity gains to counter some of these type of margin pressures which may be there. And with valuations where they are today at extremely compelling numbers, right, for good quality businesses. So while there could be one end of the market which may be expensive, but there are some extremely good quality businesses available at a fire sale, if one may say right now. The outlook is actually quite positive, and hopefully this trend will continue through the decade.
Sure. My understanding of White Oak as an asset management company when it started was that it is an alpha focused, equity focused, and these were the two, I would say, aspirations which were thrown in the earlier years. And so, true to its positioning, it is focused towards alpha, it is focused towards equities. So from that point of view, now when White Oak is growing, in my opinion, the logical expansion plan could have been from listed equities getting into, say, unlisted equities or long short equities, because through those expansion plans, you could have actually aspired towards remaining in the equities and asset class and also aimed alpha. But what White Oak is kind of progressing is towards mutual funds, which is a industry where kind of today alpha is absolutely very difficult to get, because there are various norms which kind of ensure that the fund management is restricted in a manner, and kind of we are trying to hug the index. And at the same time, industry is divided both in equity and debt. So your focus from equity will kind of get goes towards debt also. So in that regards, when White Oak, as one of the first, I would say, alternate fund houses, which has got license and ventured into mutual fund, what are your thoughts? Maybe, we are missing something which obviously you as visionaries are seeing. So we want to know, what are your views in this regards?
Yeah, thanks, Kamal. So we, as you would have seen a lot of the newspapers today, we've just announced the launch of our equity NFO on the flexi cap side. Now, if you think through this, Kamal, in India, there are three broad structures through which investors are actually invest into equities, right? They could. I'm talking about more in the managed fund space. It's either the PMS platform, the AIF platform, or a mutual fund platform, right? While PMS and AIF is targeted more at the HNI, family offices, institutional clients, the mutual fund tends to be targeted a lot more retail. Having said that, a mutual fund is an extremely tax efficient structure because of the way the whole trust structure is done and the ability to seamlessly transact on that platform for retail investors as well as many of the HNI investors. There is no parallel to that from an India diaspora perspective. So if we are, and Prashant gives this analogy quite well, right? If we are in the sport, which we call investing a sport, if we are in the game of cricket, we would want to play well in all formats of the game, right? Whether it is T20, one day international, or test match, right? Now, I wouldn't hazard guesses about trying to say which one is T20 and which one is one day compared to the PMS AIF thing. But it's the same thing. If you are very strong equity managers, alpha focused, as you rightly said, we would also want to be across all these formats. And in fact, you would be glad to know that we last week, we actually have launched a global emerging market fund out of our Singapore office. So it's not, so yes, while we could look at unlisted, long short, and some of those structures, and we may actually evaluate that in times to come. But our immediate thing is also that we would want to be, playing a global field, a much larger field, as probably the first Indian asset management company to have its own in-house team, which is going to invest into global emerging markets, right? We've always talked about bringing the world to India. A lot of our peers have been talking about showing the world to Indian citizens, but we've been focused the other way around, where we've actually got a lot of global investors to invest into India. And in a way, this goes with our thing of being able to create a much larger equity basket by, doing gems at this juncture, maybe looking at even global equities. And this all comes because of the pedigree of the founder out here, who spent a fair bit of time, started his career with US equities, did India, and then global emerging market. And an asset management company where DNA is of an investment professional will continue to focus on building its capabilities, not just from being product providers, but being, active equity advisor, active equity managers across different formats, which would be there.
Sure. So, before I ask next question, I'll give a disclaimer that I am trying to put myself in your shoes. You have taken a decision of joining White Oak. Obviously, it's a long-term decision. And in this industry, which actually has a 2-decade of history, and over the last 2 decades, today I see there are hardly any companies which are listed and which have market cap of more than say 8, 9, 10,000 crores. Only HDFC MC is one company which has around 40,000 crores of market cap. In last 2 decades, we have seen many other industries,
sure,
where we have seen the market cap expansion in a far, far better number. So what is your vision and what is your perspective over next, maybe 10 years over this decade with regards to asset management as a business or wealth management as a business? Do you see a similar growth happening over next 2 decades, the way we saw private banks coming up over last 2 decades?
Very, very, very important point, Kamal. I guess the challenges of late in the asset management space, and it's not just in India, incidentally, it's globally, has been that, earlier the fee income because of active fund management was a lot more. And the rise of passives have led to a lot lesser fees for asset management businesses. In India specifically, also what has happened with some of the leading asset management companies is that they have been losing market share consistently, because of a lot of newer asset management companies coming in and coming with niche offerings, being able to gain a lot more market share at the expense of the older more established asset management companies. It used to be a distribution game earlier in India, right? But more and more you see democratization of distribution by an end investor choosing the best performing funds, right? And which is available at the click of a mouse button. The wealth management platforms itself have got digital and have been able to provide that information fairly seamlessly to investors. So I think even in asset management, as it's happened, Kamal, in many other spaces, people will have to innovate. They cannot, you just because you have a pedigree does not necessarily mean that flows will start coming into you. You would have to, showcase different products. You'll have to create that alpha and perform to actually get those type of flows from investors which are there. And I think the opportunity is huge, Kamal, right? When you have less than 10% penetration of mutual funds, as percentage of GDP, and the financial saving pool continues to grow high. A lot of new investors coming in. Many of them, of course, came in during the last 2 years because they were sitting at home and investing. Some of them may have burned their fingers trying to invest themselves, and then they realize managed funds are a much better solution to creating long-term wealth. People start distinguishing between trading and investing after learning from their lessons. So both for wealth management as well as asset management, over a longer period of time, innovation, economies of scale, and the fact that you would have to be able to show performance is going to be extremely critical to get the right set of growth rates which people may expect. But it's you've seen this industry grow 15 to 25% year on year, depending on how, irrespective of market conditions, right? The fact that sometime back we just spoke about how to SIP book of 12,000 crores, how DII flows have countered any type of FII flows, outflows which have been there, also shows the maturity of this industry in dealing with different volatile cycles. So I'm actually extremely positive and sanguine about the prospects of both wealth management and asset management in India. We've just touched the tip of the iceberg right now.
Sure. So the topic of our discussion is when will it rain again? And obviously in equities, all of us have a long-term horizon, and we know in long term it will definitely rain, but in short term nobody can predict. So we will not talk about any predictions. However, as a house view and trying to put yourself in investor's shoe, if I was to ask you today, when you showed your slide on the alpha, where you mentioned that in last couple of quarters, some of the beaten down sectors like energy, utilities, power have been the ones which have actually performed. And some of the other sectors like pharma, discretionary consumption, IT, they have actually got beaten down because of the valuation gap. This also happened because the era we were living maybe till 2 quarters ago was a liquidity filled era, and now the era where we are living in is a liquidity starved era. So if this continues, then they at some point of time one will have to maybe change one's philosophy and try to look at some of the value picks, or you will stick to the philosophy of sticking to the good quality businesses in the expensive sectors. What are your views? Putting yourself in investor shoes, obviously you would also go out of patience at some point of time. So how do you view this particular aspect?
Sure. So Kamal, I don't think I ever tried to convey that we only look at growth sectors in constructing our portfolios. In fact, we specifically said that we create a fairly balanced portfolio which have both cyclicals and counter cyclicals. So they do have positions of value and growth. Yes, we tend to be a little bit more growth biased. And again, I'm defining value and growth more traditionally as they are. Now, as long as the companies really fulfill our framework, right, where we look at companies which are generating cash, have strong excess return on incremental capital, scalable long-term businesses, and strong execution and governance, it really doesn't matter whether it's a value pick or a growth pick. The challenges we have in a lot of value companies is that they may remain value for their lifetimes, right, before they go away. Because there is a reason why market considers them as value, and so again, I'm not trying to, say that in the next 3 months or 6 months or things will change. Just overall from a value versus growth debate, which is there right now. But the what we've seen, Kamal, is that if there are good companies, right, solid companies, as the way I've defined them right now, you will find mean reversion happening pretty soon. The earnings numbers will start reflecting in the stock prices, and the markets will start catching up out there. The liquidity question is always a debate, right? You could just have factors uh, which suddenly turn the other way around. You had coordinated central bank actions across the world of raising rates, and at some point of time there will be stability, which will be there out there. Now, whether that is that 1 quarter away, 2 quarter away, is a question mark, right? But I don't think it's all about just liquidity. When you have strong businesses, they do well irrespective of the liquidity factors. Yeah, I mean, there may be a little bit of more pop up which may happen at a point of time, but good businesses do well irrespective of what the liquidity equations are. So our own prognosis is, and we've seen this, right? We've had these type of, this is not the first time you've seen drawdowns in the market and you've seen good quality companies come off. And this is not the last time also, right? This is a market cycle which you need to ride out at this point of time. And we are very confident that over the next few months, if not or over the next 1 year, you will see the cycle turn around. And some of the companies, strong companies, which I showed in the earlier chart, which have not done well despite having very strong earnings backing them, there will be some level of mean reversion which will happen out there.
Sure. Coming on to the sector view, I can understand that because you also have a parallelly IT sector focused PMS. So your view towards IT ought to be positive. So one, I want you to kind of elaborate that what are your views in that regards today after the correction that we have seen over last couple of quarters? And apart from IT, any other sectors, say if you have to cover top 3 sectors, what would that be?
Sure. So in fact, Kamal, what are the other second PMS strategy which we have is not an IT sector PMS. It's actually called digital leaders. Digital leader strategies are again, if on one side I say that we don't take top-down thematic views, we can't be someone saying that we run a technology fund, right? Because this is not a technology fund. Our own belief is that the leaders of tomorrow are companies which will have very strong digital focus, and this digital focus could be in traditional businesses or it could be new age businesses. So actually that portfolio is a portfolio of companies which have names across traditional businesses, technology companies, as well as new age businesses, right? But the traditional businesses are businesses which have adapted to tech to deliver competitive advantage, right? So I just wanted to clarify that aspect, that we don't really run any sectoral or thematic strategies. This is more a broad bias strategy which gains in the digital ecosystem. On the sector, yeah, we are very, very constructive on the IT sector at this point of time. We believe there is no longer just cost leadership or cost arbitrage because of which Indian IT companies are doing well. We've seen some of even the smaller mid-cap, small-cap IT companies having extremely strong order execution capabilities and specialization within the niche areas of technology, and that's helping them compete with some of the top technology companies with order books wherever there are global contracts and tenders which are there. So we continue to be very positive on there. Financial sector is the other sector, the BFSI space, Kamal, where after the cleanup of a lot of the books which have happened on the in the banking sector, private sector banks are bouncing back quite strongly. And while some of them have had a short challenge on the valuations because of their own factors which may be there in play, but we see private sector financials more around banking, insurance companies, and even some of the stock exchanges actually do very well in the short to medium term. And the third area is the consumer space, and consumer is very large. It includes the whole consumer discretionary ecosystem. But again, there are companies where we believe who have very strong pricing power, are able to price in the cost pressures which they have, into an end product, and that type of demand provides a fairly good runway for the future. So these are the three top sectors we would have today, Kamal, as we look at our own portfolios.
Sure, right, Prateek. So to everyone who have joined us today, first of all, this is the very first session that we have done with Prateek, and this was very, very interesting and very enlightening. And I think it has given us a perspective on actually that definitely we need to keep our belief on that we will soon see the era of again rain happening in equities, and we need to be prepared for that. And all our endeavors, all our efforts are in that direction. And absolutely, in that stride, I would like to thank White Oak for partnering with us for this event, and Prateek for opening up this session, this event. We have 9 more sessions to go, and I hand it over from here onwards to Aishwarya. Thank you, everyone.
Thanks a lot, Kamal, for having us.
Thank you very much, Mr. Manocha, for steering that conversation. And thank you very much, Mr. Pant.